Chris Toomey here at Post 9 with me today. I feel like we should cue that sound effect like wah, 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 because that's like your view on the market. You've been cautious.
We've been cautious.
And you still are.
Yeah. I mean, look, I think when we last were here was after the FOMC meeting. Sentiment was horrible, and we were concerned about a bunch of different variables. You know, one, economically, two, inflation, three, the Fed, and four, consumer confidence. And but the thing is we thought the market was oversold. And so one of the things that we thought we would want to do is take advantage of the fact that as the market recovered, we could use that as an opportunity to start taking down risk. And that's what we've been doing for the last couple of weeks.
Selling the rips.
Selling the rips, building out a cash position. Based upon the fact that if you look at those fundamentals, they've only gotten worse, right? So if we started the year, global GDP was supposed to be at 6%. It's now sub 3%, right? We were getting the inflation number. Everybody was hoping inflation was going to peak. It hasn't peaked. And the move isn't necessarily moved from transitory. We're now looking at structural issues around inflation.
But the market went down a lot, right? I mean, didn't the market price in a lot of what you're talking about? I mean, it was expecting the fundamentals to get worse, which is why the S&P went down 20+%.
Right. No, I mean, and that's where you had that PE multiple contract, right? And that leads you to the other side of the equation, which you really focused in on is earnings, right? So we're right in the heart of earnings. And earnings have actually been not as bad as everybody feared,
right,
which is part of the reason why we've gotten this lift, right? But in reality, if you look at cycles, right, and you look at the Fed over the last 40 years, every time they've raised rates and gone through a rate hike cycle, estimates have come down, right? 2022 estimates for earnings are up 15%. Next year, up 8%. We just don't think that's possible.
One thing in your view that I thought was really interesting is that you say hard landing or soft landing, either scenario, at least in the short term, isn't good for stocks.
Right.
How so?
So, I mean, if you have the soft landing, right, we still have to see earnings come down. So maybe they come down 5 or 10%. We still have a resilient balance sheet with regards to the consumer and with regards to corporate America. We're still in a situation where interest rates have been going up, but they're not out of control right now. So you get a 5 to 10% pullback. You get a multiple going back to where it should be. You could still see equities come down 10 or 15%. We get a hard landing, right?
Well, then all bets are off. You get a hard landing.
You're going from, 225, 228 on the S&P down to 195, right? That's going to be a big difference. You've got the PE contracting, and then you've got earnings coming down even more. You're seeing kind of a 20 to 25% pullback.
You're not believing that, speaking of pullbacks, you're not believing the drop in oil either is sustainable.
No, I mean, I think one of your other guests brought it up in the fact that, look, it's going to take time to get supply back into the system, right? I think the issue is you're in a situation where China has basically pulled back demand because of the zero COVID policy. They're reopening. Demand is going to increase. You've got this issue with regards to Russia and the Ukraine, and there's just not as much you can do with regards to meeting that demand.
Yeah, I mean, but if demand slows here because of recessionary fears, doesn't that affect the supply-demand equation in a classic economic way?
Well, the thing is if demand, you don't necessarily need growth to continue to move higher. Growth can stabilize and stay flat, and you're still in a situation where you still have strong demand for oil.
What is intriguing to you now? We pumped you up and suggesting you run this highly successful and well thought of group at Morgan Stanley. I mean, what are you doing right now? I know you said you're selling the rips. So what's attractive to you to put money to work in?
Look, I think we want to be patient here. We don't necessarily want to be a rocking chair investor. We're moving back and forwards and going nowhere. We're in a situation where we own a lot of good companies. We're hedged. We're in a situation where we've got a lot of income coming off of our portfolio and our alternative side of the business. But we don't necessarily need to be investing just to invest because everybody else is investing. If you look at what's happened today, right, you got a situation where you got a technology company that's laying off almost 30% of their workforce, and the stock's up 30%. You've got a consumer staple company that has great earnings, but does it really need to be up 30%? Obviously, something's going on in this market right now that isn't necessarily based upon fundamentals.
Let me ask you lastly before I let you go, what gets you more bullish? Like, what's that signal you're looking for? Is it really firmly for a Fed to pivot? Is it a definitive sign that inflation is coming down? Is it no hard landing? Is that the kinds of things you're looking for?
I mean, honestly, it's about price. I think what we need to do is come to a realization that earnings are going to come down. If you look at earnings are good, but if you read through the comments, you're seeing things like in financials where they're taking more reserves, expecting that the consumer is going to be in trouble. All of that has to push the price down, where we've got a real margin of safety where we could feel comfortable putting money back.
You know what I'm writing down as you're saying it's about the price? It's your guy, Mike Wilson, right, at Morgan Stanley, says the price is wrong. I think that's exactly what he says, right? The price is wrong has been the principal part of his argument as to why he's been negative the way he has.
No, I think he's right. I think the fact of the matter is, I think the market is too confident with regards to the fact that the Fed is pausing or that earnings are going to be better than they will be. And in reality is, if you look back at history, we're in a situation where the Fed has to continue to be aggressive and earnings have to come down, and that is going to push the market down. So from our standpoint, be cautious, build up cash, and wait for that opportunity to put the money to work.
All right, we'll make that the last word. I appreciate the time as always. That's Chris Toomey, again, a Morgan Stanley Private Wealth, joining us now.